a misread indicator that cost billions. It began with a signal everyone thought they understood, a familiar indicator flashing a familiar message, reinforcing confidence across trading floors worldwide. Funds leaned in, positions grew larger, risk models relaxed, and almost no one questioned what the signal was actually saying. To understand why this mistake mattered, we need to revisit a period when markets relied heavily on indicators as shortcuts to certainty. Data was abundant. Dashboards glowed with reassurance. Complex systems were reduced to simple readings that promised clarity in a noisy world. And the indicator at the center of this story had earned near religious trust. This story matters now because markets still depend on indicators designed for a different era. When those signals drift away from reality, the damage doesn't arrive gradually. It compounds quietly until the cost is too large to ignore. The first reveal begins with how the indicator was supposed to work. It measured stress, signaling when markets were under pressure and when they were safe. For years, it performed well. During crises, it spiked. During calm periods, it eased. Investors learned to treat low readings as permission, to increase leverage, to compress margins, to assume stability would hold. The second reveal came when structural changes altered what the indicator actually measured. Trading became faster, liquidity more fragmented, risk more distributed through derivatives and automated strategies. The indicator still moved, but it no longer reflected real stress. It reflected surface calm. Beneath that calm, fragility was growing. The third reveal emerged quietly, through anomalies no one connected. Volatility stayed low even as leverage climbed. Credit spreads narrowed despite rising debt. Risk models greenlit exposure that would have been unthinkable years earlier. The indicator said safe, and the market listened. But a few analysts noticed something unsettling. The signal wasn't calming markets. It was anesthetizing them. It encouraged behavior that increased vulnerability while suppressing visible warnings. And once that realization surfaced, it became clear the indicator hadn't failed randomly. It had been misunderstood, and that misunderstanding was already setting the stage for losses that would soon reach into the billions. As confidence built around the indicator's low readings, behavior across the market shifted in subtle but powerful ways. Funds increased leverage because the signal implied reduced risk. Volatility selling strategies expanded because calm looked permanent. Hedging budgets were cut because protection felt unnecessary. None of these moves were reckless on their own. Together, they formed a fragile structure built on a single misunderstood signal. The conflict emerged when a handful of analysts noticed a growing disconnect. The indicator remained subdued even as market depth thinned. Liquidity appeared plentiful in normal conditions, yet vanished faster than expected during small disturbances. These analysts realized the signal was no longer measuring stress. It was measuring the absence of visible disruption. And those are not the same thing. They dug into the indicator's mechanics, breaking it down into its components. What they found was troubling. The signal relied heavily on price stability and short-term volatility, but modern markets had learned how to suppress both. Automated strategies smoothed price movements. Central bank policies dampened visible shocks. Volatility was no longer a reliable proxy for safety. It had become a byproduct of intervention. The tension deepened when these concerns were raised internally. Risk committees acknowledged the points, then dismissed them. The indicator had a long track record. It had worked before, and in institutions built on precedent. Past success often outweighs present evidence. Changing the framework would mean rewriting models, reallocating capital, and admitting that years of decisions rested on a weakening foundation. Meanwhile, the indicator's reassurance continued to fuel behavior that amplified hidden risk. Correlations tightened as strategies converged. Assets that were meant to diversify portfolios began moving together. Liquidity clustered in the same instruments across multiple funds. The market looked calm, but it was becoming increasingly synchronized. The analysts noticed another warning sign. During brief sell-offs, the indicator barely moved. Yet internal stress metrics spiked instantly. Funding costs jumped. Execution quality deteriorated. The system reacted sharply, even though the trusted signal stayed quiet. It was proof that the indicator was lagging reality, not reflecting it. Still, most of the market ignored these signs. The indicator's low readings were too comforting. They justified exposure. They rewarded risk-taking. They silenced doubt. And as long as prices stayed stable, there was no incentive to challenge the signal everyone depended on. By the time concern began spreading quietly through professional circles, the misunderstanding was already deeply embedded. Portfolios were constructed around the assumption that risk was low. Capital was positioned for continuity. Safeguards were relaxed. The analysts understood the danger clearly now. The indicator wasn't warning of stress because stress had been engineered out of the visible system. But invisibility doesn't mean absence. It means accumulation. And when accumulated risk finally forces its way to the surface, indicators that rely on calm will react too late. The market was no longer protected by the signal. It was exposed by it. The exposure became undeniable during a sequence of events so ordinary that no one treated them as a threat. A routine policy remark, a minor funding adjustment, a modest sell-off that in past cycles would have passed unnoticed. But this time, the system reacted differently. Liquidity evaporated faster than models anticipated. Correlation spiked across assets assumed to be independent. Strategies designed to offset each other began moving in the same direction. And still, the indicator barely moved. It stayed calm while the internal mechanics of the market strained under pressure. The conflict escalated rapidly inside institutions. Trading desks felt it first. Execution costs surged. Slippage widened. Orders at once cleared instantly now struggled to find depth. Risk teams saw stress metrics flashing red, while the trusted signal remained stubbornly green. Two realities were colliding, and only one of them was visible to the outside world. Analysts who had warned about the misread indicator pushed their findings again, this time with urgency. They showed how leverage magnified every small move, how volatility suppression delayed adjustment, how the indicator's calm readings had encouraged a buildup of positions that required perfect conditions to unwind safely. But by now, it was too late to unwind without consequence. The buildup accelerated as funds began adjusting simultaneously. What started as prudent de-risking turned into synchronized movement. When many institutions attempt to reduce exposure at the same time, markets don't rebalance smoothly. They gap, and the indicator, designed to reflect stress after it appears, lagged behind every move. The breaking point came when a widely held asset slipped beyond a technical threshold. Nothing fundamental changed. No new information arrived. But that breach triggered automated responses across portfolios that all trusted the same signal. Selling cascaded. Hedging failed. Diversification collapsed in real time. For the first time, leadership teams saw the truth clearly. The indicator had not been calming risk. It had been delaying recognition of it. The market hadn't been stable. It had been sedated. As volatility surged, the signal finally spiked, but only after damage had already spread. Losses mounted across strategies that had relied on its reassurance. Billions evaporated not because the market was unpredictable, but because it had been misunderstood. In that moment, the indicator's role was redefined, not as a guardian of stability, but as a mirror showing how easily confidence can become complacency. The market didn't break because the signal failed. It broke because everyone trusted it to mean something it no longer did. And once that trust shattered, the cost was measured not in charts or models, but in capital already gone. When the losses became public, confusion spread faster than explanations. Commentators asked how so many sophisticated institutions could be caught off guard by such an ordinary sequence of events. Executives spoke of unprecedented conditions. Analysts blamed speed, algorithms, sentiment. But beneath every explanation sat the same quiet truth. The indicator everyone trusted had been speaking a different language for years. The climax wasn't a single collapse. It was a collective realization. The market had been using a familiar signal to answer a question it was no longer designed to ask. Low readings were interpreted as safety when they merely reflected suppressed volatility. Calm prices were mistaken for resilience. And by the time visible stress appeared, the structure built on that misunderstanding had already begun to fail. Emergency measures slowed the damage. Liquidity support arrived. Positions were unwound at a cost. Risk frameworks were reviewed under pressure rather than curiosity. The indicator still existed, still calculated, still displayed, but it no longer held the same authority. Trust, once broken, doesn't return easily. The resolution came in the aftermath, when institutions quietly rewrote their assumptions. New metrics were added. Stress was measured in more dimensions. Liquidity depth, correlation behavior, and positioning concentration began to matter more than surface calm. Some firms adapted quickly. Others resisted, clinging to the comfort of familiar signals. The lesson lingered long after the losses were absorbed. Indicators are not truths. They are interpretations. And when the system they observe changes, their meaning must change with it. Markets evolve faster than the tools designed to monitor them. Confusing familiarity with accuracy is how blind spots form. The billions lost were not the price of unpredictability. They were the price of misplaced confidence. A reminder that no signal, no matter how trusted, should ever replace understanding. So what do you think? Are we trusting the wrong signals again? A